Current market outlook and strategy. Well, today, guys, I'm going to talk about what I'm seeing on the market in the near term, and then I'm going to talk about a bit of history. I've got some encouraging news on the markets, but I also have some signs of caution, and that comes from a historical look at bear markets in the past. And then finally, I'm going to wrap up with my current strategy, what I'm doing to deal with the uncertainties in today's markets. Let's get started. Okay, I'm going to rip through a bunch of charts now that cover a lot of the external parts of the market. So we're going to look at things like market sentiment. In other words, how people feel about the market. Are they bullish, bearish, or neutral? We're going to talk about market breadth, which is the participation of stocks on a given index. We're going to talk about different things that allow us to measure the internal health of the market. And then we're going to look at some history. So let's just rip through a number of things. And I'm going to peel through these quickly because I put together quite a few charts for you guys. And some of you that aren't familiar with a lot of these charts do take my technical analysis basics series, because I go through a lot of this type of stuff we're discussing today. I will try to explain a little bit how these work, but I'm going to probably refer you to that last video series to get the nitty gritty on these charts that I'm talking about today. So really quick, this is the S&P up here, and what we're measuring here is risk appetite index. And this is comes from a company called sentimenttrader.com, who I've been a very long-term subscriber. And they put together a compilation of indexes that show whether investors have a high or low or medium risk appetite. And it comes everywhere from what kind of options activity they're doing, what kind of volume they're trading on stocks, money flow, that kind of thing. They put it all together into one indicator. So I like looking at this because it gives me a quick look at the appetite of the market. And you can see this line down here is green. And that's because when risk appetite is very low, that's actually a positive sign. This is a contrarian indicator. Well, it reached an extremely low point just recently in late April, and it's been hooking up since. So that's actually good news for the market. So that's our first piece of positive evidence right now. Next chart is the AAII bears. So AAII stands for American Association of Individual Investors. And what they do is they ask their members, and they have many, many thousands of investors who rely on their service, and they ask their members, do you feel bullish, bearish, or neutral? So what I've done here is, instead of looking at the compilation, I'm looking at what the bears are thinking, because they're the most reliable insofar as, if there's too many bears, it often gives us a really good buy signal. And if there's too few bears, then it often gives us a reliable sell signal. And you can see through 2024, we had a lot of bulls. There was too few bears, effectively, because this is looking at bears only. But look what's happened recently. So when the market started to peel back, of course, everybody becomes bearish. It's like the horse got out of the barn, so close the door. It's too late to be bearish when the market's already gone down, but that's why we're talking about retail investors here, because this is a measurement of what we in my industry call dumb money. So now, one of the things I want you to notice is that, when there are too many bears signaling from the AAII survey, it does often find a bottom. But the problem is that you see how long that lasted? It didn't really put in a bottom, and it didn't really start rising until that indicator had stayed up here for a while. So just keep that in mind. There was another signal here. It was quite accurate. Again, it can last a while before the market actually starts to return to a true bull market. But again, another positive that we have to pay attention to on the market right now is the fact that people didn't like this market right when it was selling off, which is great. Okay, next contrarian indicator is the Smart Money, Dumb Money Confidence Index. And you guys know I've written a book called Smart Money, Dumb Money. I talk about trading off of fear and greed and market sentiment. And I actually got the name of my book, or I was inspired for my book title, by this indicator. What it does is it pits retail investors, that's Joe Average, and their money flow. It looks at things like mutual fund flow, ETF flow, because it's mostly retail investors that buy ETFs. And then it looks at small trades and stuff like that. And then they can get a pretty good indication of what small investors are doing. They pit it against the more sophisticated money out there, the big pension plans, the big investors like Warren Buffett's Berkshire Hathaway, and other large hedge funds that are generally considered accurate. And it puts them together, and what it does is it sees if the smart money is buying or selling, and whether the dumb money is buying or selling. So dumb money is red for caution on this chart, and smart money is blue. And you can see that smart money, as the market fell, became more and more interested in buying. That's because, see, retail investors love the market when it's high, and they hate the market when it's low. They're always doing the opposite of what they should be doing. So smart money has been buying this market. Now they are starting to peel back, as you can see on this, and dumb money is starting to come back in. At some point they'll meet, but at this point it looks relatively bullish from a contrarian point of view. Smart money is still in the green zone. Dumb money is just coming out of the red zone. Next indicator, some of you guys will be familiar with this. The VIX, Volatility Index, basically it just measures option premiums. The higher the premiums, it means that investors are expecting more volatility. They want higher premiums when they sell you a put or a call, and that means they are feeling very, very concerned about the market. They're expecting volatility. So you can see in history, for example, going back to 2020, you guys remember the COVID crash, and other such periods like just before the 2022 market and coming into the bottom, we had high readings of the VIX, high readings of fear. Well, look at this spike here. Just recently, when the market bottomed in April, the VIX spiked to something like 52. Now that is a very, very high reading. The VIX hit around 82 during COVID, so that was one of the highest ones we've seen in history. But 52 is a very, very high reading, and of course that signaled the recent pullback and bottom, or at least temporary bottom, on the market for the time being. So it was a good signal. Now it's returned to a more normal reading. So that's actually a good sign again. So far we're seeing a few good signs. Now we're going to look at market breadth. And what I want to show you is the market breadth of advancers versus decliners on the broad index called the New York Stock Exchange. Now the New York Stock Exchange index is comprised of about 1,800 stocks, I believe it is. And that's a pretty broad index when compared to the S&P 500. So when we see that the advanced declines on the New York Stock Exchange are doing well, that gives us an indication of healthy market internals. And that's exactly what we're seeing. You can see this is the black line, which is the advanced decline line for the New York Stock Exchange. And take a look. It's been doing pretty good. There's the peak in February, or the last peak. There was the actual peak was late in 24, but it made a peak in February, and it's just reaching that right now. If we compare that to the S&P 500, which is the red line, and if I zoom in here a little bit, you'll see the red line is way below its February lines. So it's got a lot of catching up to do. And the reason for that, by the way, is that technology has been in the doghouse, whereas other stocks haven't done as poorly. So that's the reason why the New York Stock Exchange is showing us that market breadth is spreading. Participation in market components is getting healthier. Remember, it's never a healthy market if we only have a few participants, which is what we had in 2024 and even part of 2023, when it was all about the AI stocks and technology stocks. I am glad to see that breadth is widening. You should be too. Another positive sign is the corporate insiders buy-sell ratio. Now, this is pretty simple. There's the S&P 500, which is comprised of actually a few more stocks than 500 stocks. It's something like 505 stocks or around that level. But whatever the case, the 500 stocks or so of the S&P 500, and we're looking at every company on the S&P 500 and whether the corporate insiders are filing that they just bought their own shares or they sold their own shares. Corporate insiders have to disclose their stock trading movements. Well, when you see corporate insiders not buying their own stocks, it's usually a sign that they know the market's overvalued. They know that their company is overvalued, so they stop buying, and in fact, they sell. Okay. Now, reverse is true though, because if they start buying and stop selling, that can be a good sign. Well, guess what? Leading into this market correction, it's one of the reasons why Craig and I at Value Trend raised a lot of cash. Corporate insiders were not very excited about their stocks. Now remember, this is looking at all 500 plus companies. It's an average of the ratings. It doesn't mean every corporate insider wasn't buying, but most corporate insiders were selling their stocks or not buying on an aggregate basis. So we saw that. It was a really good signal giving us a heads up that the market was likely to be soft, and it certainly has pulled down, as you can see. But now we're starting to see that these insiders who know their businesses more than you and I ever will are starting to buy their own stocks. They feel their stocks have gotten cheap. So now let's look at a bit of history of bear markets, because again, we're trying to figure out if the market is reversing from a bear trend. Remember, we have to be agnostic, guys. Don't make flat assertions. We've talked about this in the past in my other videos, that amateurs make flat assertions. Analysts are open to any possibility, weigh the odds, and bet in the direction that the odds seem to be the best risk-reward ratio. That's what I try to do, but nobody really knows what's going to happen. So one of the things we can do to try to make guesses, or educated guesses is probably the better word, as to what the market's going to do is look at history. We can look at all those indicators we just saw, and they're relatively bullish, as you saw. But the other thing we should look at is, well, what's happened in the past? And so this is a look at the 2001 to 2002 bear market. So you can see here's just at the end of 2000 right here, and there's 01 and 02. And you can see what happened is right around the middle to end of 2000, the market peaked and began to fall. Well, what happened was the market rallied to this red line, which is the 200-day moving average. Okay, it's actually the 40-week, but that's roughly equivalent to the 200-day moving average. So it rallied to the 200-day, fell, climbed again to the 200-day, fell, and ultimately bottomed with a nice hammer formation that you guys will know if you've watched my technical analysis basics. A hammer formation is often very bullish, and it certainly was at the end of the bear. But that bear lasted almost 2 years and took the market down by close to 50%. So sometimes what I'm trying to show you here is that markets can head fake you. In fact, I've done studies on bear markets going right back to 1900, and I will tell you the only one that I can recall of any significance that made a V reversal and came right back up was 2020, COVID. And that's because that was a fairly extreme sell-off, fairly short-lived. But in most cases, markets don't just go down and go right back up again and carry on their merry ways if it's a true bear market. So what we want to be doing is, as we follow history, watch and see if the S&P 500 hits and then fails at the 200-day moving average. Let's take a look at another bear market. Well, here is the 2008 and 9 bear market. So this is 2007, this is 2008, this is 2009. What you can see is the market once again peaked near the end of 07 and began its bear market. Look what happened. This blue line, in this case, is the 200-day moving average. What did it do? And I've even circled it for you. It hit the 200 and fell. This time it did another short rally, failed pretty close to the 200 and fell like a brick. So this is a common element of bear markets, is that they don't just go down and reverse and turn on to a bull market all over again, and they usually test the 200 and fail again. One more bear market study to look at, and that is the one that just happened 3 years ago, 2022. So here's the peak, here's 2022, there's the peak, and it was pretty much over by the time we hit early 23. And what you can see is the 200-day moving average right here, the market fell. It actually blew through the 200 for a couple of weeks, and then boom, fell again, made a nice low, tested the 200, made another low, tested the 200, and it wasn't over until the market could consistently remain above the 200-day moving average. So there's no predictions to be made here on what is happening today. What I am going to talk about next is my strategy, knowing that if this is a continued bear market, we must pay attention to the 200-day moving average. So with that in mind, let's take a big picture look at the S&P 500. It was in a bull market. That bull market ended with a bit of what could be a double top. And there's the move. Actually, I'm going to erase a couple of my lines here. This red line is the 200-day moving average. I'm going to give you a close-up of this in a minute, guys. So don't worry if this seems too small to look at. But the market broke to 200 and it broke the 50-day moving average. And it is now trying to rally. I'll give you a close-up in a second. But what I want you to notice is that right now we're starting to see some signs of indicators such as money flow momentum, the MACD, which is a longer-term momentum indicator, and RSI reversing from an oversold position. So this is good news. Now, remember, though, sometimes you get, during bear markets like 22, you do get these reversals, and it ain't over, as they say, till the fat lady sings. So just be aware that just because we're starting to see these three indicators hook up from an oversold position doesn't mean we can't have another test, another lower low, another pullback. So I'm just pointing out that there is some positive signs in this market, but it really all comes down to the 200-day moving average. So on that note, let's take a look at the S&P 500 on a daily chart with a very narrow zoomed in lens. So this is the S&P 500 since last June of 24. And what you can see is it first broke the 50-day moving average, which was very common. And then it broke the 200-day moving average. It tested the 200-day right here and fell. Okay, very common thing to happen. Now it has rallied and it's gone through the 200-day. Now, again, I'm recording this on May 6th. And what's happening today as I speak is this candle right here. If I zoom in, this is today as I write. I'm recording this halfway through the day, and it moved down quite a bit on the day, but it seems to be stabilizing a little bit. The main thing we're going to watch for is that we want to see if the 50-day can hold, and then if that can hold, if it will hit the 200 and break through. If it cannot break through the 200 by any extent of time, in other words, if it breaks through for 4 days or something, I can't necessarily say that's a bull market yet. But if it can't break through materially, you might say, then I would say that the market is still in a bear market. And in fact, if it fails here at the 50-day, I would suggest we're on our way back down to the recent lows. We can't make predictions on any of these things, guys. What I can tell you is that my strategy right now is I continue to hold cash, I continue to hold my gold, and I continue to hold low beta stocks for those stocks I do hold for the most part. So if we see an adherence over the 50-day moving average, I will probably do one leg in. Now we are over the 50 right now, but I want to see this stability last for, as I said, a minimum of 3 days. Today is actually day 3, so I'm going to give it another couple of days. And if the market stabilizes above the 50, then I will probably put in another leg into the market, but I'm still going to hold lots and lots of cash because the real test is always that 200-day moving average. So you've seen it through history that the 200-day moving average can contain a bull market return. So I hope that sort of gives you some ideas on the good and the bad and the ugly, I guess you could say, on the stock market. Right now, we have a lot of positive sentiment and breadth indicators, as you saw at the beginning of this video. That makes me excited for a potential turnaround in the market. However, history has shown us that we can get head faked by failures around the 200-day moving average. Virtually almost every bear market you'll find has shown a rally to the 200 and then failed. So if this is a bear market and not just a short-term correction, then you will see the market fail somewhere near the 200 in the coming weeks. If you see it break through the 200, I'm going to suggest that's a positive sign and time to get a little bit more serious about legging back into the market. Thanks for watching, and we'll catch you next week. Hey, thanks for watching. I hope you got value out of this episode. Please like and subscribe below. We're trying to grow the channel, and it would really be doing us a big favor. I'm presenting ideas every week on trades that we're actually looking at Value Trend. And by the way, I don't just talk the talk. I walk the walk. I have been a portfolio manager for 35 years, and in fact, I was one of the very early pioneers in technical analysis here in Canada. On my website, valuetrend.ca, you will see a link for our online trading course. And this course is a complete money management system. I do encourage you to take a good look at that and consider taking it. I priced it extremely low because I want retail investors, that's you, to take the course and get value out of it. It's literally my 30 plus years of experience put into one complete step-by-step course. And honestly, I wish that I had had something like this when I was an early investor. It really will stop you from making so many mistakes. I also suggest you subscribe to our Never Miss an Opportunity program, which is our blog and our newsletter. There, you're going to get ongoing ideas, tons of charts, lots of trading ideas. And by the way, we never, ever solicit. We don't send you junk spam and stuff like that to try to get your business. It's for information, because part of my passion is to teach retail investors how to invest properly. I've been doing this, as I said, for 35 years, and I hope that I'm able to pass on some of the things that I've learned through this career as both a pioneer in technical analysis in Canada and a longtime portfolio manager. Thanks for watching. Don't forget, push like, push subscribe. See you next time.